Imagine trying to steer a high-speed train, but someone forgot to lay down the tracks. You are moving fast, avoiding collisions, but eventually the system breaks down. This is what running a financial fund feels like without a clear map of the rules. In Luxembourg, the CSSF lays down those tracks. As the official financial watchdog, they have released their safety tracks for the year 2026, a new set of supervisory priorities. If you are looking at these priorities for the first time, they can feel overwhelming. It looks like a disjointed list of upcoming audits and complex terminology. These priorities actually organize into a single 8-part map. From your core financial entity, there are exactly 8 paths you need to secure. Compliance acts as a predictable, structural defense mechanism that protects you and your clients from modern threats. The first path on our map covers your internal governance. You might hire outside companies to handle daily tasks, but your firm remains responsible for every regulatory requirement. You must audit any outside partners using 14 specific principles created by ESMA. They are the European authority setting the standard for how to handle risks from third-party providers. Our second path focuses on technology and cyber risks. As funds move their operations online, the targets on their backs grow. Every digital tool creates a new doorway for a potential cyber attack. To lock those digital doors, you need a framework called DORA, the Digital Operational Resilience Act. It is the new required manual for digital survival. Specifically, your team needs a rehearsed plan to report any major tech failure or cyber attack directly to the regulator. Before facing the open market, your internal governance and your digital walls must be completely impenetrable. Now we turn to the market. The third path deals with liquidity risk. This is the question of whether your fund can survive if a sudden massive wave of investors all ask for their money back at once. This diagram shows assets hitting a sudden bottleneck of cash outflows. You must stress test liquidity management tools to prevent crashes. Our fourth path is interconnectedness. High debt acts as a vulnerability multiplier, triggering a chain reaction across the market. That leads to the fifth path, asset valuation risk. Geopolitical crises make it difficult to figure out the exact fair price of investments that are hard to sell. The CSSF will rigorously monitor your net asset value, basically the price tag on your fund, to ensure there are no math errors and that you are following your own investment rules. Surviving a market panic requires knowing exactly what your assets are worth and how fast they can be turned into cash. Our final paths look directly at the investors. The sixth path focuses on costs and fees. Fund managers must review every transaction cost and performance fee to prove they are acting in the best interest of investors and avoiding unnecessary charges. The seventh path targets sustainable finance. Regulators are increasing their scrutiny of green claims to protect investors from greenwashing. This means your public sustainability disclosures must mathematically align with your actual portfolio data. Finally, the eighth path is financial crime. Preventing money laundering and the financing of terrorism remains a top non-negotiable priority. These local rules connect to the broader international standards set by the IOSCO AML network. Fiercely protecting the investor's wallet and adhering to global ethics secures long-term capital as much as market performance. The complete map organizes every regulatory demand into a single logical process flow. A compliant fund is a well-organized business where every branch of this matrix is fully documented. Take this roadmap and perform an internal gap analysis. Identify which of these 8 branches are currently missing from your daily operations. Meeting the 2026 CSSF standard builds a strong foundation for unshakable investor trust, far beyond simply avoiding penalties.